Welcome to the Corporate Venturing Insider Series, where I interview top practitioners in the CVC world and learn with you the best practices and golden nuggets that they have accumulated over their career. In this episode, we will be learning from Rashmi Gopinath, General Partner at B Capital Group. Rashmi, could you take a few minutes to share your story and how you got to where you are today?
Absolutely. Thanks, Nicholas, for this opportunity. I did have a very unconventional, non-traditional path into venture. My early professional career began in product roles. So I am an engineer by training and started off my career at Oracle and GE Healthcare, mainly building products on the core product and the core engineering team. At Oracle, I primarily focused on building database, DevOps, and analytics products. I was part of the application server suite product team. And at GE Healthcare, I mainly focused on building analytics products. So what we were trying to build at the time was a data interoperability platform that brought in data from multiple sources and provided insights to healthcare providers into care coordination and care gaps and the other critical pieces of the workflow. During my time at GE, we were in the process of launching a new product to market. I was getting pulled into a lot of discussions around pricing and packaging and product launches, marketing positioning, acquisitions, partnerships to help accelerate our product roadmap. And I would say many of the business concepts that I was still getting up to speed on, I figured that a business school degree will help accelerate the learning that I needed to be successful in those roles. And so I decided to get an MBA. So I went to Northwestern. I was doing my MBA part-time at Kellogg when I worked full-time at GE Healthcare. And I would say it was at Kellogg that I first got exposed to investments and entrepreneurship and was quite excited to get my feet wet in the process and ended up with a couple of internship opportunities during my MBA. One was with a growth equity fund in Boston that focused on growth stage equity investments. And the second was with a small private equity fund in Chicago that mainly focused on buyouts in the enterprise software space. Really loved the venture experience that I had during my time at Galen Partners. And I found quite interesting the ability to bring in my product and engineering capabilities into the investments and the financial and the business to get a more holistic perspective. And post Kellogg is when I decided that I wanted to explore a full-time career in venture capital. And so ended up coming to Intel Capital post Kellogg. And Intel Capital had obviously been around for several years. I would say one of the most active CVCs, deploying north of 500 million in investments each year. I was part of the enterprise software investment team, which was still new and was getting set up. And so my role on the team was to help invest across cloud infrastructure, cybersecurity, DevOps, and SaaS. I would say a great time to be part of a growing investment team was in 2011 and ended up investing in some really amazing companies like MongoDB and Forescout, Imaginetics, Basis, and others. And I would say it was also, an eye-opening experience to see what it truly meant to help startups and help operators in what they're doing in building the company. And I would say the experience gave me a pretty deep perspective into what startups need to do to be able to grow and succeed. At Intel Capital, we were stage agnostic. So we invested across the board from early seed stage rounds to late stage pre-IPO stage rounds. And so I would say the exposure that I had as part of Intel was pretty rich. And I would say it was a great experience working with a fantastic team, investing in some really sharp companies. One of the things that I had noticed about myself that I wanted to address was I did not have any startup operating experience. And while we can all advise companies behind closed doors on what they need to do, I had observed that the investors that came from an operating background were able to offer more realistic hands-on feedback to the company and had that trusted relationship with the founders because they had been in their shoes as well. So after about 2.5 years at Intel Capital, I decided to get some operating experience myself. And so ended up joining one of my own portfolio companies at Intel, a company called Blue Data, which was in the cloud infrastructure space. What we were primarily doing at the time was helping enterprises that were adopting big data technologies to leverage virtualization to get to scale. So I joined the team when it was 5 or 6 engineers, and my role was to help with everything on the go-to-market side. So started off on the product side, switched into product marketing, ended up doing business development and helping us land our first initial set of customers. And I would say it was a great experience just seeing firsthand for an early stage startup what it takes to win the first 10 customers, what it takes to establish product market fit, what it takes to help build the partnerships with the large incumbents like the Microsofts and the Intels, and help the company raise a few rounds of funding, was there for almost 2.5 years. And at that point, we ended up with multiple acquisition offers on the table from the likes of Intel and HP and others. And I did not want to move back into a large company just yet. I was hoping for a little bit more operating experience. And so I ended up joining Couchbase, which is a NoSQL database startup. By the way, Blue Data ended up getting acquired by HPE. Couchbase was a growth stage company. I had known the team because I'd invested in MongoDB and I'd looked at data stacks, and Couchbase as well as part of that. And my role at Couchbase was to lead the global business development team. So I figured that I had the early stage experience and I would really benefit from the growth stage experience to see what growth stage companies needed to accelerate from that 30, 40 million of ARR to the hundreds of millions of ARR. And it was a great experience. I primarily helped build out the partner ecosystem comprising of OEMs and resellers and system integrators, tech providers. Did that for about 2.5 years. And at that point, I was getting a few inbounds back from the investment side. Microsoft was one of those opportunities. And it was, again, a time when Microsoft was getting to its peak under Satya's leadership. And it was the first time that Microsoft was going to set up a venture capital team. So I was quite excited, I would say, about the opportunity to build a fund from the grounds up. And the operating experience that I just had got me even more excited about the building aspect. So I ended up joining the team in 2016. I was the second person to join the team. So it was a really exciting experience building the rest of the fund and the team. And we set off with very bold ambitions of wanting to be a top 10 CVC in 2 years. And it was very fulfilling to see that come to fruition. We assembled a great set of people. We ended up being extremely active on the investment side. I think we made almost 50 or 60 investments in our first 2 years. Our focus was more on the earlier stage. So we did, I think, from seed to Series B stages of investments. And so I stayed with Microsoft for close to 5 years before I ended up joining B Capital in January of last year. So B Capital is an institutional fund. We primarily focus on growth stage investments. We have just now launched our early stage fund. So we will be a multi-stage venture fund. But on the growth side, I primarily focus on Series B all the way up until pre-IPO rounds to invest in the same spaces that I covered at Microsoft and Intel. So I invest across horizontal enterprise spaces, cloud, cyber, DevOps, AI, and SaaS. We have a global presence. So that's, I would say, a common thread that I had both from my time at Intel and Microsoft as well. And we have, I would say, one of the unique models or structures for an institutional fund where we have a strategic partnership with the Boston Consulting Group. They're a minority LP fund, and we work with them quite closely on the go-to-market side. And that, for me, was one of the appealing factors when I joined B Capital, was I had seen how the corporate model worked at Intel and Microsoft and the benefits that we can bring to portfolio companies. And I don't think I can point to any other institutional fund that has a similar structure. So for us to be able to tap into BCG's network and their access into the global 2000 customers to get our portfolio companies into those accounts, partner with BCG and get access to all of the research work that they do was quite unique and would give us that differentiation when we needed for those competitive deals. So I joined the team about a year and a half back. I'm based out of our San Francisco office, and it's definitely been a great transition. And I'm happy to provide any additional context as we talk about the different approaches to investing on the CVC and the institutional side today.
Thank you, Rashmi. There's so many places I want to double click. I'll try to go chronologically from the start of your introduction. I think one thing you mentioned is very true for hard tech investments is you really need to have a good product view, really need to understand the technology and the product. Do you think that if you don't have this good product view, you can still be a good investor? Or do you think this is really something you would encourage anyone in the audience to really have that experience? You've got the operating experience, which is clearly something I want to touch about. But what about the product view? Is that something that's a must or?
Yeah, it's a great question, Nicholas. And it depends on, I would say, what sectors you're investing in. Obviously, I would say venture capital is a field where everyone has their own paths. So there isn't a set formula that you do these three things and that leads to a successful investing career. If you're a SaaS investor, you don't necessarily need to have a technical background, but there are certain sectors where you absolutely need to, and there are certain sectors where it's a great advantage if you do.
Now, let's talk about the advantage you've lost by moving from a corporate VC to a financial VC, because you talked about a lot of the win-wins that you created between the mothership and portfolio company. What is one thing you miss the most from being in a corporate VC?
Access to technical diligence. I could pretty much do that like in a few minutes, where I could just like ping one of the product teams in Microsoft, and in most cases, they would have either used this startup product already, or they'd be able to take like a quick demo and tell us like how good or bad the product is. I try to maintain that still at B Capital through the relationships that I have with folks on the technical side, but it's just so much easier when you're part of Microsoft and you can just pick up the phone and speak to one of the data scientists at Microsoft and ask them what they think.
I think it's an unfair advantage of CVCs. When we look at battery companies, we have the world's expert inside TDK. I totally relate with the quality of the due diligence, very fast, very deep, like very few people can get access. Can you give me another thing you miss, maybe?
I would say the brand and the reputation is another one. And I would say when M12 was a new entrant in the CVC space, this is where we would cheat and we would like pull in the Microsoft name. Whenever we wanted to win a competitive deal, we can bring all of this resources and access to Microsoft. And I would say for most institutional firms, it takes time to build brand. The investment market is insanely competitive and everybody looks the same to a founder. And so to set us apart, we have to be creative about what we can use to our competitive advantage. When it comes to CVCs, it's very obvious. If you're taking in money from Cisco, you know what Cisco brings to the table. You're taking money from Salesforce, you know what Salesforce brings to the table. With Microsoft, with Intel, with TDK, it's very obvious. You don't have to come in and explain why you need to be on the cap table. For the institutional investors, it's difficult. And unless you're a Sequoia or an Andreessen or a Lightspeed, where your brand is established and people seek you out, for the rest of the institutional firms, the competition is fierce. And a lot of it depends on the individual GP's reputation, what they bring to the table, as well as what can you do in terms of unfair access to the CXO network, which is what we're leveraging BCG for.
Very nice. Actually, when you talk about differentiation, a corporate VC has an unfair advantage. It's got this connection to the mothership. And I've seen many CVCs being very cautious about mentioning the mothership, but actually this is your unfair advantage. You need to find a way to embrace it and leverage it. I think what B Capital is doing is very smart. You're leveraging something that's very obvious and can add value. How difficult is it beyond what you're doing with BCG to create even more differentiation?
Yeah, so this is where, again, from our platform capabilities, we've been quite laser focused in terms of what do startups care about and how do we offer it to them. So today, our platform capability has four key pillars. One is on talent and recruiting. So it's not just helping our portfolio companies with recruiting efforts, we also bring in the expertise to help with org design, org structure. How do you build a high performing team? How do you roll out a performance review process? Like how do you adopt OKRs and all of that? So it's a lot of design and structure along with the more tactical, we can help you recruit PMX CMO. The second key pillar is around capital formation. So we have a team of experienced ex-bankers on our platform team that can help with exit opportunities, tuck-in acquisitions, venture debt, future fundraising, alternative fundraising options, which again become quite helpful and meaningful for companies at the growth stage as they're thinking about what are additional capital sources that they can tap into. The third key pillar is around the CXO network. So in addition to BCG, we have our own business development team that builds a CXO network across different industries and sectors that we can tap into. So we did one for financial services recently where we had our portfolio companies come in and pitch to them. And then the fourth one, which we call a strategy and ops, is basically we have a team of ex-strategy consultants on our platform team that can help with anything around assessing a new market that our portfolio companies want to go into. What is the best practice around launching a new product? Many of our portfolio companies have multiple product lines. And so we can do a pricing optimization study to say, here is like how you would want to tweak the pricing for these particular segments or these particular use cases. So that's in addition to, again, what BCG brings to the table. And that's something that we continue to be creative on in terms of what else can we be doing to help our portfolio companies. And as a result of that, help differentiate us. Because at the end of the day, we want to go back and create case studies and say that we did X, Y, and Z for these companies, and we were able to influence their growth from, I don't know, 50% to 80%. And that becomes then something that sets us apart.
There are many golden nuggets you're describing and a virtuous circle really where you keep improving and adding more pillars, all about helping portfolio companies that then will rave about you, case studies, and you continue. What I also liked is you're extremely clear about what is the value you bring and how it's structured. It's not like you have to think about it. You live and breathe this value add to the entrepreneurs. Do you have any way of closing the loop with the entrepreneurs where you ask them what they value the most, what you should accelerate, maybe what you should do less of?
Yeah, absolutely. So we actually run surveys with our portfolio companies every quarter where we ask them to rate us on the projects that we've delivered for them and what are some of the proof points that we can see. The easiest to measure is the recruiting efforts that we help with, where we can see how many people have we placed and how much of their pipeline have we influenced through customer introductions. I think the more nuanced ones are these strategic projects where if we are running a pricing study or if we're running a new market study. So that's where we get some of the more contextual feedback through these surveys that we run with our portfolio companies. But they're like the best judges of how effective we've been.
Exactly. The value add is only value add if it's appreciated by the recipient. Right. Is your survey like an NPS survey or is it more of an open question survey?
So the survey is both. We ask them to rate us. So that would be like an NPS on the projects that we've run. But then we also take a lot of open-ended responses back from them in terms of what else we can be doing, how else we can be improving.
And if at very high level, you were looking at the full resources of B Capital, how much percentage of your bandwidth do you think are deployed to help entrepreneurs, your portfolio company?
I would say that the platform team is as big or probably bigger than the investment team. Our portfolio today is about 70 companies. So yeah, I would say the investment team is about 25, 28 people. The platform team is at least 30 or more.
Okay, that is actually a fact. This is
Yeah.
really clear. Very nice. Can you talk about the stage? I think we are 2 minutes left. So you had experience of stage agnostic investments with Intel Capital, then early stage investments at M12. Now you're more in growth stage investment. Any tips to the audience about what you've learned of doing these three very different disciplines?
Yeah, so I would say what the investors look for at the different stages, it's slightly different. There are some common threads. I would say team is common across the board. It doesn't matter whether you're a seed stage company or a pre-IPO stage company. The investor is going to ask who's the team and who's running the ship. At the early stage, I would say it's a bigger bet on the team, the product idea, and the TAM. And as long as like those are like proven out, those are interesting enough, that's what drove the interest levels. At the growth stage becomes more of a science than an art. There's a lot of numbers and metrics that we look at, but our definition of growth is fairly broad. We can do Series B and we can do a pre-IPO round. At the pre-IPO round, it's primarily numbers driven and like how big do we think this opportunity gets. At the Series B and C stages, it still is a lot on product market fit. How is the team executing? Which segments are they winning today? How do we help them grow bigger? So I would say some of the nuances are similar at those early growth stage, and then at the late growth stage, it just becomes more financially driven.
Thank you, Rashmi. I think this was an interview very rich of insights, golden nuggets, best practices. And I think your journey is amazing because it feels like it was conscious. I'm not sure if it was always conscious, but you build skills that are necessary for you to be really performing where you are today. I look forward to meeting you face to face as soon as we can. But thank you for your time and sharing so much. Thank you.
Would be. Thank you so much for that, Rayo, and for the opportunity, and look forward to speaking again.
Thank you. Bye.
Thanks, everyone.